The US dollar has ruled global trade for 80 years, but right now, the primary mechanism of that dominance is beginning to fracture. Most Americans are currently unaware that this shift is underway. We have lived under the assumption that American purchasing power and global leverage are permanent, guaranteed fixtures of the world economy. When costs rise or the economy feels strained, the public typically focuses on domestic political cycles as the sole cause. By framing a global currency shift as a local political dispute, we overlook the external forces currently reshaping the American way of life. The current threat to American wealth is gathering in foreign central banks and international oil ports. If the dollar loses its status as the world's primary reserve, the impact will be felt in the daily expenses of every household in the country. The forces determining the value of your savings are operating thousands of miles away, beyond the reach of the American voter. In the 1970s, the petrodollar system established a global rule. If a country wanted to buy oil, they had to use US dollars. This requirement created an automatic, massive global demand for our currency, regardless of what was happening inside our own borders. That system is now breaking. The BRICS Plus nations are actively creating pathways to trade oil without using the dollar at all. Major powers are now settling massive energy contracts using their own local currencies. Millions of barrels of oil are currently moving through the global market without a single dollar being exchanged. Every barrel sold outside this network removes a layer of the demand that supports the dollar's value. The evidence for this shift is visible in the data tracked by global institutions. This chart uses IMF data to show that the dollar's share of global foreign exchange reserves has dropped to a multi-decade low. Nations are diversifying their holdings at an accelerating rate, moving away from the dollar in favor of other assets. The IMF figures show that de-dollarization has moved from a theoretical risk to a present reality. Under the old system, high global demand allowed the US to print currency and effectively send its inflation abroad. As this flowchart shows, foreign nations acted as a sponge, absorbing our debt and keeping the domestic supply of dollars in check. As oil-producing nations stop requiring dollars, those offshore trillions have nowhere to go but back into the United States. At the same time, the global appetite to buy and hold US debt is drying up. This creates a situation where the domestic supply of dollars increases sharply, while the global demand for them vanishes. When trillions of dollars return home, they dilute the value of the money already in your pocket. This international currency shift eventually settles in the local economy. This loss of value is what causes the price of basic staples, like a carton of eggs, to rise at the grocery store. It means a fixed amount of savings will buy less than it did only a few years prior. The inflation felt at the checkout counter is the end result of oil being traded without dollars on the other side of the world. Beyond local prices, losing financial dominance removes the primary tool the US uses to influence global events through sanctions. It also limits the government's ability to fund its programs without significantly increasing the cost of borrowing. This currency shift is driven by mathematical outcomes, making it indifferent to which party sits in the Oval Office. Understanding these global mechanics is the first step in seeing the reality of the American economy. Follow to see the data behind the forces shaping your financial future.